Over the past few days, the silver market has flashed one of the loudest signals it emitts, actually shown in years, and most people missed it. While silver sentiment has drifted into near religious territory, a veteran commodities operator quietly sold roughly 78% of his physical silver holdings, not because he turned bearish, not because the long-term thesis broke. He sold because the trade changed. Then he rotated that capital into something most retail investors ignore until it SS already doubled: quality mining equities. That decision forces an uncomfortable but necessary question. Are you investing, or are you emotionally attached? Because in commodity cycles, that difference determines who compounds capital and who becomes exit liquidity. Silver isn't wrong, but the crowd is late. Silver has surged, and the narrative is everywhere. Currency debasement, industrial demand, electrification, solar, geopolitics. The dangerous part isn't that these arguments are false. It is that they were just as true when silver was cheap and nobody cared. Price action didn't create the thesis. Price action made the thesis feel certain. That's how bubbles form, not from lies, but from late discovery and emotional reinforcement. So when a longtime operator trims aggressively into euphoria, it's not a prediction of collapse, it's discipline. He treated physical silver as a speculation bucket, not a sacred object. And when the risk-reward shifted, he moved. You don't need to call the top to make a great decision. You only need to recognize when another expression of the same theme offers a better payoff. The core rotation logic. In plain English, owning physical silver is a one-variable bet. Price must go up. Owning a quality silver miner is a leveraged operating business. If silver simply stays elevated, margins can explode. And when margins explode, valuations tend to follow. Mining profitability isn't linear. A modest increase in metal prices can double free cash flow because costs done at T-scale the same way revenue does. That's why miners can outperform even if silver goes sideways. And here's the key inefficiency. Most equity analysts still model miners using conservative silver price assumptions, especially after a big move. That creates a gap between metal reality and equity pricing. When that gap closes, it can close violently. Not all miners are created equal. Miners will outperform is a lazy statement. Many so-called silver stocks barely produce silver. Others hold marginal projects that require endless dilution. Some exist primarily to sell hope, not ounces. The opportunity lives in a narrow subset: high-quality producers with real cash flow, royalty, and streaming businesses with diversified exposure, developers with credible paths to production and disciplined capital structures. The junk will not rise with the tide. It will be exposed by it. The junior mining trap. Retail investors consistently fall into the same mistake. They confuse possibility with probability. A junior can own a great deposit and still destroy shareholders through dilution. A junior can look exciting and still do nothing for years due to permitting, financing, or political friction. A high probability double beats a low probability 10-bagger, because most 10-baggers never happen. Capital structure and timeline matter more than drill results. Physical silver versus speculation. Physical silver serves two very different purposes, and confusing them is how people get wrecked. Insurance, protection against systemic risk. Speculation, a bet on price appreciation. If you're stacking silver because you believe you may need it in a monetary storm, keeping a core position makes sense. If you're stacking because you expect a rapid price explosion, that's speculation. And speculation requires rotation when the payoff changes. Miners offer multiple ways to win. Silver flat, margins expand, costs fall. Debt is retired. Dividends or buybacks appear. M&A re-rates valuations. Physical silver has won. Why miners are still underloved. Sector trauma from past dilution and disasters. Capital obsession with tech, starving real assets of attention. Passive ETF flows favor liquidity over value. That leaves real opportunities mispriced, but only for disciplined selection. Tight markets, straight lines. Silver's industrial demand is real, structural, and often price inelastic in the short term. But tight does not mean straight up. Tight markets are sensitive. They move higher than expected and drop harder than expected when marginal buyers step away. That's why discipline matters more than conviction. Gold's role, insurance, not hype. Gold remains closer to insurance than speculation. It benefits from negative real yields, fiscal drift, and declining trust in paper promises. But gold can still fall 30% and remain in a bull market. If you can't emotionally handle that, you will sell at the wrong time. The gold thesis only truly breaks under. Sustained fiscal discipline, honest debt reduction, meaningfully positive real yields. We are not there. Streaming, royalties, and hidden leverage. Royalty and streaming companies sit between physical metals and operators. They often provide upside exposure with less operational risk. But valuation and deal quality still matter. Many silver streams are tied to copper projects, meaning silver exposure can expand as copper financing ramps. That cross-metal dynamic will matter more in the coming cycle. The real risk in the next phase, the most dangerous phase of a metals bull market, isn't the crash. It's the middle. Prices are high. Euphoria is widespread. Management teams issue shares aggressively. Retail feels like it's winning while being diluted. Liquidity, not hype, determines survival. A simple framework. When evaluating a miner, ask, do they produce real ounces today? What are all-in costs and energy sensitivity? Debt levels and maturity profile? Share count trend over 5 years? Jurisdictional risk? Management behavior? Owners or promoters? These questions alone put you ahead of most participants. Final takeaway. Selling physical silver to rotate into miners is not a rejection of silver. It's a recognition that the payoff profile shifted. You can remain bullish without being reckless. You can believe in metals without worshiping them. The edge in commodity cycles comes from separating insurance from speculation, rotating when risk-reward changes, avoiding emotional attachment. Surviving long enough to compound discipline is the real alpha.